And I think that the place they're going to move it now, more so, is into gold and silver, but also into basic commodities. Commodities are vastly underpriced historically to themselves and to other asset categories. Like the Bloomberg right now is around 104 or 5. Its high in 2008 was 237. And right now, certainly the stock market doesn't care about, quote, economics. It cares about, a bad number, bad economy, great, Fed's going to print. A new high by 10% by the S&P over the January high. You wobble back down a few more percent points, you're going to go back through that high. And then people will say, I thought we had a breakout. And that's when the panic's going to hit. Meaning that people in the stock market who felt comfy will suddenly feel uncomfy.
In today's news recap, Goldman hikes December 2026 gold price forecast. Goldman Sachs raised on Monday its December 2026 gold price forecast to $4,900 per ounce from $4,300, citing strong Western exchange traded fund ETF inflows and likely central bank buying. We see the risks to our upgraded gold price forecast as still skewed to the upside on net because private sector diversification into the relatively small gold market may boost ETF holdings above our rates implied estimate, Goldman said. Gold has climbed 51% so far this year on strong central bank buying, increased demand for gold-backed ETFs, a weaker dollar, and growing interest from retail investors seeking a hedge against rising trade and geopolitical tensions. Goldman expects central bank buying to average 80 metric tons in 2025 and 70 tons in 2026, saying emerging market central banks are likely to continue the structural diversification of their reserves into gold. Western ETF holdings are expected to rise as the U.S. Federal Reserve is seen lowering the funds rate by 100 basis points by mid-2026, analysts at Goldman Sachs said. In contrast, noisier speculative positioning has remained broadly stable. Following the large September increase, the level of Western ETF holdings has now fully caught up with our U.S. rates implied estimate, suggesting the recent ETF strength is not an overshoot, it said. Now smash the subscribe button and turn on notifications so you do not miss out our daily recaps, and go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
The ongoing thing of gold and monetary metals, I call them monetary as opposed to like platinum, palladium, which are precious, but there's a difference between precious and monetary. 3,000 years of history, gold and silver being money, okay. If you look at, go to a Federal Reserve St. Louis, their FRED chart, they call them, and go to an M2 chart, money supply, okay. And just look at it. Go back 50, 70 years, however far back they go, a long time. And look at, and move your little arrow along and go to the first of the decade, January of 1970, and then go to January of 1980 and 90, and write down the number. What was the money supply then? It's parabolic. Okay. And meaning the decay in the real value of the stuff in your wallet. We're a miniature, most countries in the West are, miniature versions of Venezuela. Okay, we made fun of that a couple of months ago. We put a Venezuelan stock chart on page 1 and said, boy, we should be long Venezuela, because the chart is parabolic, the stock market. And you say, well, that's great. No, it's not, because the degradation of the money ongoing constitutes the explanation of why the thing's going straight off the page. So is the price of dog food or a roll of paper, was exploding as well. Well, when you go back, that many decades in the U.S., basically the money supply increases about 90%, almost doubles, in other words, every decade. Sometimes more, sometimes less, and especially when the central bank gets nervous about this, that, or the other data point. Usually that's associated with the stock market downturn when the data points really start to go sour. Then they start printing more, okay? Well, gold goes up and holds its value against that ongoing degradation. And silver does too, although it's been lagged, especially over the last couple decades, to what gold has been doing. Gold's way above its 2011 high. Heck, copper is above its 2011 high. And there's a lot of base metals out there that if you circle where you are now and go back to where, 10, 20, 30 years ago, you say, gee, silver. Silver has made a mistake. Investors in silver have made a mistake. This happens in markets. You've got enough experience. If you go back to 2007 and 8, the market collapsed for reasons that, the guys in the story, they knew why it was going to collapse. They knew a couple of years ahead of time, and yet the market wouldn't do it. And then finally it did collapse and paid its dues for that which it already had done. One of these situations where not only is monetary metal going up, gold especially, the mama market, and silver's coattailing it, still very undervalued to gold, but it's catching up and it's erasing years of underpricing relative to a lot of things, to gold, to the degradation in the money unit. For example, if you just arbitrarily go back a quarter of a century, it'd be the October of 2000, okay? And look at the S&P. Right now it's up 3.5-fold from where it was then. It's actually less than the degradation in money almost. Gold's up 11+-fold, okay? So it's held its value against degradation of money. And that's a factor that's ongoing in all markets. And there's times when, let's say, the stock market reaches a bubble point where it's been ridiculous for too long, overpriced versus reality. And there's a lot of fundamentals out there that, that normally look at the earnings and so forth. And those don't seem to work precisely, but they're a ballpark warning. And yet it's still up there. So markets make mistakes, and when they do, the erasure of that mistake is often horrendous. Like, let's say the dot-com top, NASDAQ 100, for example. When it turned down, S&P went down 2 years to 2002, 50%. NASDAQ 100 went down 82%. You talk about cleansing, okay? And it wasn't that what it was up there for was wrong. In fact, the dot-com bubble was totally valid. It changed our lives more than people even thought, and the internet did. Mm-hmm. And yet it still erased 82% of it, and it took it till 2016 for the NASDAQ to even get back to the price it had been in 2000. So, the point being that a lot of these things that happen, like if the stock market's going to top, as we argue it's topping, or the monetary metals are going to accelerate now, it's because of not factors that are necessarily new headlines, but old stuff that's finally getting recognized. And I think that's where we are at a very dramatic point, especially for silver.
In today's precious metals headlines, gold climbs above key $3,900 level for first time on safe haven demand. Gold prices touched an all-time high on Monday, soaring above $3,900 per ounce level as investors flocked to safe haven bullion amid the U.S. government shutdown, broader economic uncertainty, and prospects of further Federal Reserve rate cuts. Washington will start mass layoffs of federal workers if U.S. President Donald Trump decides negotiations with congressional Democrats to end a partial government shutdown are absolutely going nowhere. A senior White House official said on Sunday, there are concerns that the U.S. government shutdown could become protracted with a negative impact on U.S. growth, said independent analyst Ross Norman, adding that a pervading sense of caution in financial markets helping gold. Gold has climbed nearly 50% so far this year, underpinned by strong central bank buying, increased demand for gold-backed exchange-traded funds, a weaker dollar, and growing interest from retail investors seeking a hedge amid rising trade and geopolitical tensions. This rally characterized by low participation and primarily driven by central banks with a long-term outlook and steady investors rather than speculative buyers, indicates that any pullback might be milder than expected, Norman said, adding that this could present a buying opportunity on dips while the rally maintains its momentum. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
One, it's anticipating, and remember, gold's not some dumb market that follows headlines. There might be a day here or there where, something happened in Iran. We dropped the bomb and therefore, whatever. These excuses come and go. People like to latch onto them and say, well, that's why it happened. Okay. But it's ongoing, and gold knows that if, one, we have the biggest stock market bubble in U.S. history, which we've been arguing you do have, both in terms of age of the bull market, most of the bull markets in the past that we call bubbles, like the .com or 29, they were only 4 or 5 years. And the multiple gain was like 3 or 4-fold at most. And then you still collapse. Well, we've gone up, 20-fold in the NASDAQ since 2009. S&P's gone up maybe 10, 11-fold since 2009 low. Which, because, 700 level on the S&P. And the duration has been like triple the norm. And you can look at a money supply chart or a Fed funds rate chart, the short end of the market, of the debt market, and see why. Because we've been given a Cheech and Chong injection of happy money, free money. In fact, 10 of the last 15 years, the rates were effectively zero. You go back 75 years, and even when they raise rates to 5%, that's low compared to the last 75 years. That's in the lower quadrant of the rate levels. Okay, so the stock market's been fueled by free money. And that's why, the stock market's up today. Why? Great unemployment report. Why is it great? Because it means the Fed's going to cut and print. They got more excuse to print. And that's all we care about. Give us more injections, boys. And that's in effect, it's a miniature Venezuela market. Print the money, will go up, okay? So will the price of, when I was a kid, a loaf of bread was 20 cents, okay? What is it now? When your granddad built a house, it cost, the median price was $4,500. Now it's $450,000, okay? What does that reflect? Degradation in the money unit, period, okay? And when the Fed has more incentives in this ECB and the Bank of Japan have more incentive to print, that money goes somewhere. Now, quite often it'll go to the stock market, but even the stock market historically will get to a point where it says, golly, I've gone too far with this game. And it breaks. And when it starts to break, people with assets who are smart will begin to get out and move somewhere else. It's never the case where everything goes down. That argument is not true. Gold has always risen in bear markets. Back in the 1930 to 32 bear, after the crash, we had a big rally in the stock market back halfway to the high, and then the bearish market started. It went down like 80%. Gold miners, you couldn't buy gold because it was illegal. Okay, government knows best. But homestake mining went up like 1,000%. Okay, during the huge bear market in stocks. Similarly, 2000, 2002, stock market went down big. What did gold do? It was advancing. It kept advancing till 2011. 2007 to 2009, stock market went down big. During that time, except for a month or two in there, an interruption, gold went up big and continued on up big. So the money goes elsewhere. Gold is getting some of that money already, certainly not from U.S. investors, but from foreign investors, governments as well. But when the U.S. stock market shows another fracture, not that headline chasing sell-off that we had in April, tariffs would sell it, okay? The reason for the market to go down is not some new news. It's based on, one, the massive excess of the past 15 years finally has reached a point where even if they keep printing, it won't help. Why? Because in 2000 to 2002, the Fed printed like crazy to save that bear market from happening. It didn't work.
What do you think of his take? Do you agree with him? Is a big rally coming for gold and silver before a big top forms, or will gold and silver outperform all expectations? Let us know your honest opinion in the comment section down below. Smash the hype button if you enjoy our recaps, and check this video right here because you'll love it. I'll see you on the other side.